Hello everyone, welcome back. Today we will be covering Chapter 2, which is the recording process. Let me see if I could pull up the presentation. Here it is. And let's start the slideshow. So let's begin by briefly reviewing what was covered in Chapter 1, which was the accounting in action. And the first objective that was covered was to identify the activities related to the accounting process, which were three. There were to identify an economic event, record the event, and communicate the event. Remember that there are two types of accounting users, including internal users such as managers and CEOs, and external users such as investors and creditors. The second objective was to explain the building blocks of accounting, ethics, principles, and assumptions. In terms of ethics, we covered the Sarbanes-Oxley Act. We saw a video in relation to that, and we learned about GAAP, which are generally accepted accounting principles. We learned about the Financial Accounting Standard Board and the Securities and Exchange Commission. And we also covered the historical cost principle, where you record the value of a property, for example, at the price that it was purchased, and the fair value principle, where the value recorded changes depending on the current value, which can fluctuate. Now, the two assumptions in accounting, remember that it is the monetary unit assumption, where you only record the transaction that relates to money, and the economic entity assumption, where the owner separates personal transactions from the business. This is the accounting equation that we will work with for the remainder of the semester. We cover the basic accounting equation, which is assets equals liabilities plus owner's equity, and the expanded equation, which is assets equals liabilities plus owner's capital minus owner's drawings plus revenues minus expenses. We analyzed transactions and recorded them in tabular form, just like you see here. And we did that by identifying at least two accounts that were affected by the transaction that we were analyzing, and by making sure that the ending balance were equal to each other, or they were equal to the based on the accounting equation equals which was assets equals liabilities plus owner's equity. The last objective I did not cover in last week's lecture. I will cover it today, which are the four financial statements. And we have four financial statements, which are income statement, owner's equity statement, balance sheet, and the statement of cash flows. In the income statement, as you see in this visual, it represents the revenues and the expenses for a specific period of time. So we have the revenues up here and the expenses. It is very straightforward, and it shows that the revenues for a specific month or a quarter. In this case, is for the month ended September 30th, 2017. The second piece of information is the list of expenses, which is right here. In this case, the list consists of salaries and wages, rent, advertising, and utilities. Then you sum up the expenses and you determine the net income, which is right down here, or the net loss. If you are making money after you pay your expenses, then you will have a net income, as in this case, which is $2,750. If not, then you will be reporting this as a net loss, and so this title, instead of net income, will be net loss, and then you would put the amount that you are reporting as net loss. Now, the owner's equity statement summarizes the changes in owner's equity for a specific period of time. Remember that owner's equity is what the owner can claim once all liabilities have been paid. So for this statement, which is also for the month ended September 30th, 2017. We report how much money was in the account on day 1. See, we have owner's capital on September 1st. There was $0 in the account. And then we add any investments. Remember that in your homework assignment, you added an investment because you were going to invest your own money into the business. This is what this represents, is $15,000. And then you add the net income from the income statement. And as you can see from this arrow, you see how the income statement relates to the owner's equity statement. You will just grab that net income or net loss and you will transfer it to this line. Then you subtract any drawings. Remember that an owner can draw money to pay himself or herself for the month to pay the, personal bills. And so these will be drawings that were made by the business owner to determine the owner's capital at the end of the month. So you would report them here. And so at the end of the month, you will see that the owner's capital is now $16,450 versus at the beginning of the month, which was 0. Now let me see if I can get out of here so I can show you this full picture, because it's not all there. It's gonna cut off. What happened here? Right here. I'm gonna try and blow this up. You see the balance sheet here. The balance sheet shows the assets, liabilities, and owner's equity in 2 categories. This is in relation to the basic accounting equation. And this is not for a specific period. In this case, it's for a specific date. It's for the day of September 30th, 2017. Now, the other 2 statements that we just talked about reported activity for a period for the month of September. And this could be a month of September, a particular month in the calendar year, or it could be a quarter statement. But just remember that for the balance sheet is based on a specific date. Now you report all of your accounts under assets. Remember, we've been working with 4 accounts so far: cash, accounts receivable, supplies, and equipment. So you report all of your balances there, and you add them all up to determine your total assets. Okay? Then you list the liabilities and owner's equity right here to determine that total. So you're going to put in your category liabilities and any accounts that are under there. You're going to see that right now we're working with accounts payable, and then all of your categories under owner's equity, which in this case is owner's capital. Okay, and you determine the total. And as you can see, it follows the accounting equation: assets equals liabilities plus owner's equity. So that will tell you that these 2 numbers need to be equal, okay? Now, they must be equal, otherwise something is wrong, okay? The last statement, and also too, you notice that owner's capital, you already determined that up in owner's equity, so that is in relation there. So every time you have to do a balance sheet and you have to draw in your owner's capital and you've done your owner's statement beforehand, just make sure you drop that value down here so you don't have to redetermine that. Now, the statement of cash flows is the last one, and this reports information about cash receipts or cash inflows and cash payments or cash outflows. This is reported in 3 categories, and you can see it here. You have the cash flows from operating activities, you have the cash flows from investing activities, and you have the cash flows from financing activities. And the goal of this document is to report the cash flow at the end of a period. In this case, it's also the month ended on September 30th, 2017. Okay, and you report that down here. So notice that all of these statements except the balance statement, the balance sheet, is the only one that reports for a specific period. The rest of them, for a specific date. The rest of them report on a specific period. Okay? And that is all we learned in chapter 1. Let's go back here. So you learn in chapter 1 how to analyze business transactions in terms of the accounting equation, and you learn to present the effects in tabular form. Okay, so let's go back. Now, the tabular format that you learn in chapter 1 is a basic way of recording accounting transactions, and can be a method that you can adopt if you have a small business. However, ask yourself this: what about if your business is growing and the number of transactions per day are in the hundreds or even thousands? Do you think that the tabular form will be a method that will be practical for you to follow on a daily basis? Well, if you were in person, I hope you will say no, because this method is very time consuming. So in this chapter, chapter 2, we'll introduce you to the recording process, which streamlines the tracking of transaction data. In chapter 1, you learn that there are several accounts within the parts of the accounting equation. Remember, for example, assets, you had the cash, you had the supplies, you had the equipment. All those were accounts within the accounting equation. So here we review what is an account. An account is an individual accounting record of increases or decreases in a specific asset, liability, or owner's equity. And an account consists of 3 parts, as the visual shows here. You have the title, you have a left or debit side, and the right or credit side. We refer to this illustration as the T account, simply because the format resembles a T right here. You see this T. Now, you ask yourself, what are debits and what are credits? Well, many of you may think of a debit as a minus, a decrease, or a negative number, while a credit is a plus, an increase, or a positive number. This concept seems logical when dealing with your checking or savings account, but this is not the case in accounting. Debit does not mean decrease, and credit does not mean increase. Okay? As you can see from this visual, debits and credits both increase and decrease depending on which account you are dealing with. Notice that here, assets, if you want to increase, it's a debit, and if you want to decrease, it's a credit. But in liabilities, if you want to decrease a liability, it's a debit, and if you want to increase a liability, it's a credit. Notice that it's different for the rest of the accounts too. So what is the point of this? I need you to erase that debit means negative and credit means positive. I need you to erase that from your brain and only remember that debit is the left side and the credit is the right side of the account. That is it. Debit is left, credit is right. Left for debit, right for credit. Now also please note that debit is abbreviated as DR and credit is abbreviated as CR. Okay? Now to show you visually and relate this concept with the tabular form that you learned in chapter 1, let's look at this visual. I brought back the rules for debit and credits on the accounting equation. That's just for you to visualize this, but let's focus on this visual down here. One of your asset accounts is cash, correct? If you remember from your homework, you invested some money to open a business. In this visual, it shows an investment of $15,000 in cash. Okay? Now look at your debit credit rules under assets, because cash is part of assets. When you want to increase the cash account, you do so by debiting. You see that there's a plus sign under the debit. You increase the cash account by debiting the T account. So translating this information from tabular form to the accounting form, we document this $15,000 on the left side of the T account, or a debit. Notice that your debit and credit rules show this T account for assets, and this is the T account for cash. You want to increase money, you debit it. You want to decrease money, you credit. Okay. Now let's say that this $7,000, you notice it's a minus. It represents $7,000 worth of equipment that you purchased in cash. This means that your cash account was decreased by $7,000, correct? Looking into the debit and credit rules for assets, when you decrease the cash account, you credit the T account. You see that? So translating this information from tabular form to account form, we document the $7,000 on the right side of the T account, or the credit side. Okay? Similarly, we continue this process depending if the cash is withdrawn or deposited into the account. You see all these here represents you deposited $15,000, you minus $7,000, you deposited $1,200, you deposited $1,500, and then you minus $1,700. And all that is going to be recorded on the T account for cash as it either debit or credit, depending if it's increasing the account or decreasing the account. Okay, now notice that we have a balance of $8,050. After all of these transactions are recorded, we have a positive balance for cash, right? Or if this is an asset in general, we say that we have a debit balance. Okay, debit balance, because it's a positive number, so it's on the debit side. A credit balance is when the credit amounts exceeds the debits. Okay. Alright, so now the visual for debit and credit rules will be your best friend for this semester. Until you memorize this chart, I suggest that you keep this visual close to you when completing your homework. And before you know it, the information on this chart will become second nature to you. But until then, just follow the rules and you will do just fine with the homework assignments. Okay, now notice under liabilities that the rules are opposite from assets. Remember that liabilities are your credit cards or your bank loans. When you charge a debt on your credit card balance increases, correct? So, well, when you record this transaction, you are giving a credit to your liability. Notice that in order to increase a balance on your liabilities, you have to credit that. Okay? And when you decide to make a payment on your credit card, your balance will decrease, right? Usually your statement comes in that you made a payment, and so your balance is now lower. Well, in order to decrease your liability, you need to debit. You see how there's a minus here. Also, notice that the rules change for owner's equity. You see these? All these are for owner's equity. Depending on the account that you are working on, will depend if you debit or credit, and it will depend if you want to increase or decrease your account. Okay. We already covered that, so let's go into what's next in the accounting recording process. Another step in the accounting recording process is journalizing. Keeping a journal is what most people use in the recording process. It is referred to as the book of original entry. And give me 1 second here, I have the phone ringing. So, continuing with the lecture, the next step in the accounting recording process is journalizing. Keeping a journal is what most people use in the recording process, and as I said earlier, it is referred to as the book of original entry. And the journal shows the debit and the credit effects on specific accounts. So the journal makes the following contributions to the recording process. It discloses in one place the complete effects of a transaction. It provides a chronological record of transactions, and it helps prevent or locate errors because the debit and the credit amounts for each entry can be easily compared. Okay, and so let me put this in the slideshow. This visual shows a complete journal entry, just as down here. You have the date of the transaction, the account titles, and the amounts to be debited and credited. And one thing you notice is that the first line is not indented. This is the first transaction here for equipment. But the second line is indented, the line for cash. When you journalize, you will always enter the debit first. Remember, you will determine which one, depending on which account you're dealing with, if it's a debit or a credit. Every time you journalize, the first line should be what you are debiting first, which is not indented, and the second line will always be the credit line, which is indented. Okay. After each transaction, you would add a brief description, which is right here in parentheses. And this brief explanation will include clear information that will inform the accountant what the transaction was for. Then, of course, you have the debit and the credit columns. So, in summary, the journal is a place to record all transactions in the business in chronological order. Okay. Now, from the general journal, this is the general journal, another visual. This is for September 1st, and notice that there's a debit for cash first and then a credit for owner's capital, and you know that is a credit because it's indented. From the general journal, we then transfer the journal entries to the ledger accounts, and these bottom ones are the ledger accounts. This is called posting. And this visual clearly shows how to transfer a general entry to the ledger. Basically, what you are doing is separating the transactions and posting them in the appropriate account, whether it's cash or liability. In this case, it's cash and owner's capital. Okay, one extra component of the ledger is a column for balance. Okay, and basically what you're going to be doing is for each line that you post here in the ledger, you're going to find what that balance is. Whether it's adding cash into your account, that you put what that balance is. If you're going to be deleting money from or taking out cash from your account, then you're going to put it in as a credit, and let's say it's $2,000, then your new balance is going to be $13,000, and so on. Okay, so let's put all this information into perspective. From this visual, we can see what we learned in Chapter 1. We have a description of a transaction that needs to be recorded. It says that the asset cash increases $10,000 in owner's equity. Here's a transaction. I'm reading the basic analysis. On October 1st, this company invests $10,000 in cash in an advertisement company called Pioneer Advertising. So that's our transaction that they give us a description for. Then we analyze the transaction to determine which two accounts are affected. Remember, we need to affect at least two accounts. In this case, it's determined that the cash is increased by $10,000 and owner's equity is increased by $10,000. Okay? When we then record these transactions in tabular form, and you did that in Chapter 1 with the Excel sheet. Okay? And it's in reference to the accounting equation. Remember, it was cash is under assets and owner's capital is under owner's equity. Now the next step is to complete the debit credit analysis by following the debit credit rules. Okay? Once that is determined, you journalize the transaction. Here's a journal. And lastly, you will post it in the ledger with the corresponding accounts. Okay? That's basically what you're going to be doing this whole entire chapter. This visual shows you what the general journal looks like. Think of this as your checking account statement that you receive every month. The statement for your checking account records all of the transactions you made within the month, correct? You paid bills, you deposited money, you took out money. Same concept here, except you record the accounts that are affected by the transactions, and you determine if there are going to be debits or credits according to the debit credit rules. So in this case, it shows that on April 1st, supplies were purchased for $5,000, and accounts payable will tell you that you paid it using a credit card on account. So this transaction here, you say that it's for buying supplies on account. Okay. Now, and then on April 30th, you decided to pay the credit card balance by $3,000. So you paid it in cash. So this is the two accounts that are affected. You debit accounts payable for $3,000, and you credit cash for $3,000. And that's to pay charges on account. And you continue that with the journal. Every time that there's a transaction, you record it in one journal in chronological order, remember. Okay, now this visual shows you what a general ledger looks like. Let's go back to the checking account statement. Pretend that you would like to know how you spent your money on a particular month. You want to know how much money you spent on food, how much you spent on gas, how much you spent on clothes, etc. Well, think of the general journal as the statement that separates the transactions based on each account within the accounting equation. So you're going to separate all the stuff that you have here in the general journal by accounts. Okay, you're going to have your supplies accounts, your accounts payable, and your cash. And any transaction that affects each of these accounts, you will separate it in the ledger according to the date in chronological order. Okay. Along with this information, you have to have a balance column, which states the balance of each account after each transaction. Okay, so in here, on April 1st, you charged supplies on your credit card. So you credited $5,000. Your balance was $5,000 on April 1st. But on April 30th, you decided to make a payment to the account for $3,000. So you debited $3,000. So now your new balance on that account is $2,000. And this is what the $2,000 represents. So how do you know if you recorded everything correctly? One way to check is by completing a trial balance. This is what a trial balance looks like. And basically what this is a list of accounts with the balances that you determined over in your general ledger. You see how you have supplies account $5,000, your accounts payable is $2,000, and your cash is $7,000. All you do is transfer it to your trial balance. So basically what this is a list of accounts with the balances, and the balances will be recorded on either the debit or the credit side, depending if there's a debit or credit balance. Remember that a debit balance is when the total of debits, the total of debit amounts exceed the credits, and likewise a credit balance is when the credit amounts exceed the debits. Okay, so what you do is to list each account with the balance on either the debit or the credit side, and then find the totals for each column. You will know that everything is done correctly if the debit column is equal to the credit column. But just please note that the trial balance is only a checkpoint, and there will be instances where the debit side and the credit side will equal, but it will still be incorrect. This may happen if a transaction is not journalized, or when a correct journal entry is not posted, or when a journal entry is posted twice, or when incorrect amounts are posted. Now, the last part of this lecture would be to complete your homework assignments. And in order for you to know what to do, I'm going to provide you with a little example to help you visualize what you need to complete for your homework assignment this week. Let's use this example here. This is Renato's travel agency. And basically, it's going to bring you back to the homework assignment that you completed for Chapter 1. We have a transaction here that says, on April 1st, Renato paid $5,000 for supplies in account. So if you remember from your first assignment, from your first chapter, you needed to analyze which accounts are affected by this transaction. And you need to remember that you need to affect at least 2 accounts. In this case, when you are buying supplies on account, supplies is going to be a key word that is under assets, and on account means that you are paying it with a credit card, so it's a liability. So you're going to be dealing with the assets and the liabilities. And then now you need to ask yourself, okay, supplies is going to be under my assets, and is this purchase for $5,000 going to increase or decrease my account for supplies in assets? Well, you're buying $5,000 of supplies, so that's going to increase your assets. And if you look under the assets rules, in order to increase the account, you need to debit. This is the reason why I put here that you need to increase supplies or debit for $5,000 since this is an asset. Now, the other part of this transaction is you're going to charge it to your credit card. So it's going to be under accounts payable, which is part of your liabilities. And you're going to be charging to your credit card, which is going to increase the amount that you owe on that credit card. So if you notice, if you want to increase liabilities, it's going to be a credit, which is the reason that I put here. You increase accounts payable or your credit for $5,000 since this is a liability. So how do I transfer that? So we worked on Chapter 1 with the tabular form, and I showed you an example earlier in the lecture on how to convert that into the account form. And so what we're going to be doing here is using these T's accounts and have one for each of the accounts that are affected. In this case, it's supplies and accounts payable. And we determined that in the supplies account, you're going to increase the account, so you're going to debit. And remember, debit means left. So you're going to be adding the date of the transaction on the debit side and adding $5,000 on the debit side or the left side. Okay, now when you are increasing accounts payable, we determined that increasing liabilities is a credit under accounts payable. So we go to the T account that's under accounts payable, and the credit is on the right side. So we write that transaction date for April 1st for $5,000 on the right side or the credit side. And that's all you do. Now the next transaction says on April 30th, Renato made a payment for $3,000 for the supplies charged on account earlier in the month. So now this means that at the end of the month, Renato decides to make sure that they wants to submit a payment to his credit card balance so it could be decreased. So it's going to be affecting our accounts payable account and our cash account. It's going to affect cash because we're going to be paying this credit card with cash money. So let's look at accounts payable. Accounts payable is part of a liability. And we're going to decrease the amount, right? We want to make sure that the balance goes from $5,000 to $2,000 because we're going to make a $3,000 payment. And in order for us to decrease the amount under liabilities, you have to debit, right? Under the liabilities. And debit is on the left side of the equation, or the left side of the T account. So we're going to record that on the debit side on April 30th. for $3,000. And that's the reason I put decrease accounts payable as a debit, since this is a liability. Now, we also have to decrease our cash account because we're taking money out of our cash account in order to pay this credit card statement. And you know that cash is an asset. So if you look at the asset side and you know you have to decrease the account, then that tells us you have to do a credit under the cash account. So we're going to go over here and we're going to record that as April 30th for $3,000 on the right side in order to decrease it as a credit. Now notice here that there's a statement here that says on April 1st there's a balance for $10,000. Remember that when you open up a business, usually you invest money in cash, so there's usually a cash balance on your cash account. Perhaps there was none, so this balance could actually be a zero if there was $0 in the account. But in this example, it shows that the balance on April 1st was $10,000. And they put it in as a debit because if you look at the asset side, in order to increase the account, you do it as a debit. So you'll see this from time to time where you see a balance on an account, and that's just the beginning balance before you actually start making your own transactions based on the directions on the assignment. And then on April 30th, you credited the cash account for $3,000. Okay, and that's all you do. And if you notice, on each of these T accounts, there's a balance. And the balance either lands on the debit or in the credit side. And I explained to you earlier that when the debits are greater than the credits, then you have a debit balance. In this case, we only have supplies for $5,000. There's nothing really on the credit side, so our balance is going to be on our debit side because the debits are greater than the credits. And the balance is going to be $5,000. Now here, we have transactions both on the debit and the credit side. Okay, and you see that the credits exceed the amount of the debits. When the credits are greater than the amounts of the debits, we have a credit balance, which is the reason why we have a balance on April 30th for $2,000. And the way we end up with $2,000 is, remember, we charged $5,000 in supplies, then we made a payment for $3,000, so our new balance is going to be $2,000. And the same thing for cash. We started with a balance of $10,000. Then we took out $3,000 in the cash account to make the payment for the credit card as a credit. And if you see that debits are greater than the credits, so we're going to have a debit balance. And in this case, it's $12,000. And the way we came up with that is $10,000 that we started. We took out $3,000. We end up with $12,000. This is the first part of what you would need to know for your homework assignment. Now the next, you'll see in your homework assignment that you need to be journalizing this. So based on these steps that we took here, we're going to journalize. And remember that a journal is where you record every single transaction in one place and in chronological order. We bought supplies for $5,000. And remember, supplies is an asset. And in order to increase assets is a debit. And remember that when you journalize, you always debit first and you credit second. The debit is not indented and the credit is indented. And what I mean by indented, that it's shifted a little bit to the right. See how there's a space here. So when you journalize, you're going to journalize the transaction and you're going to write down the two accounts that are affected by the transaction. So in this case, it's on April 1st, you bought supplies for $5,000 and you paid with it on account, or you used the accounts payable account because you paid it with a credit card. So you're going to debit the supplies account for $5,000 and you're going to credit the account for $5,000. And then you add in parentheses a little description as to why you did that transaction, and in this case is to buy supplies on account. The second transaction is you made a payment for $3,000 in cash, right? So on April 30th, you're going to debit the accounts payable for $3,000, and then you're going to credit the cash account for $3,000. And then you add a little blurb in parentheses to describe why that transaction was made, in this case to pay charges on account. And you continue doing that depending on the number of transactions that you need to journalize. Once you finish with the journal, and remember, a journal is like your credit card statement where everything that happened throughout the month, you record it there in chronological order. But then now you want to separate it based on each account, right? So that's where the general ledger comes in. You're going to take all of these transactions and separate them and lump all the supplies transactions together, and then all the accounts payable transactions in another category. So here we're going to have the supplies account, the accounts payable account, and the cash account. For supplies, if you notice in all of these on this general journal, there's only one transaction that's related to supplies, which is the first one. I don't see another supplies account after that. That's the reason why in the supplies account here for the general ledger, there's only one transaction. That happened on April 1st. That was to buy supplies, and it was done by debiting $5,000. And then you're going to record the balance for $5,000 for that line. And then since there's nothing else to really apply here, you bring down the balance at the bottom, which is $5,000. Now you go for accounts payable. And you go back here. And you see that accounts payable is actually affecting two transactions. One here, which is a credit for $5,000. And another one here, which is a debit for $3,000. And they're on two separate dates, April 1st and April 30th. You're going to take those two transactions and record them under the accounts payable area. So on April 1st, you charge supplies on the accounts payable account for a credit of $5,000, and the balance was $5,000. And on April 30th, you made a payment on that account for $3,000 as a debit, so your new balance is going to be $2,000. How did I come up with that? Well, when you bought supplies and you charged them on account, your balance was $5,000, but then you made a payment for $3,000 as a debit, so now your new credit card balance is $2,000. And those are the only two transactions that affect that account, so you are done with this account and you bring down the balance as $2,000 at the bottom. Lastly, you do the same thing for cash. Cash, you see here that it was made, there was a payment here for $3,000 as a credit. Okay? And we also had a balance. Remember we had that balance here? We began with $10,000. Gotta make sure we put it in there. So this is the reason why we have two things here. We have a balance on April 1st that began as a debit for $10,000. And then on April 30th, we made a payment on accounts payable. So we took out cash as a credit. And our new balance will be $7,000. And since this is it for all the transactions, then you bring down the balance at the bottom. If there were more transactions that were related to supplies or accounts payable or cash, then you would see more transactions in this page as well. Okay? It all depends on the number of accounts that are affected based on your analysis. Now you're going to be checking to see if you're doing everything right by doing a trial balance. And remember, a trial balance is just taking the balances on each of these accounts on the ledger and putting them all under one table for easy viewing and access. We have cash, supplies, and accounts payable. And remember that when the debits are greater than the credits, then you have a debit balance and you put it on the debit side. And when your credits exceed the debits, then you have a credit balance and you put it on the credit side. In this case, our cash balance was $7,000. Whoops, what happened here? Let's go back. In this case, we have what happened here? In supplies, we had a debit balance of $5,000. So we put in a debit debit balance for supplies. Then we had an accounts payable balance for $2,000 on the credit side. So we put accounts payable on the credit side for $2,000. And then lastly, we had a cash a balance of $7,000, and that was as a debit. So we put cash as on the debit side for $7,000. Now, just to make sure that we are balancing this account, I also added owner's capital here. Owner's capital, remember, is the amount that the owner can claim after all the expenses are paid. Okay? And so that is a credit on $10,000. I added this. I know it's not part of any of the discussion that we had before, but if I don't add the owner's capital in here, these two columns are not gonna balance. One column on the debit side will be 12,000, and on the credit is 2,000. And then you're gonna say, well, it's wrong because it doesn't balance. Well, it does balance because there's other things that are going on with these transactions. But in order for me to just be simple about it and straightforward to explain the homework assignment, I didn't include everything, all the transactions. Remember in chapter 1, you did more transactions than just 3 when you completed the tabular form. So I added this for just simplicity to make sure that my trial balance is balanced to show you that process. So once you finish posting all of your trial balance accounts, your accounts balances on your trial balance, then you're going to be adding the debit column and the credit column. And you have to make sure that the debit column equals the credit column, which in this case is $12,000. And that is all that you have to do. So now let me take you to the homework page, the Blackboard page, so I can show you what you are expected to do for this week's assignments. Under week 4, you're going to see that you're going to have your chapter reading, you're going to have your PowerPoint, and then you're going to have your lectures. This time I split the lectures in 3, partly because, I was interrupted in the first part. And in the second part, I just kind of left it off with the lecture. The third part, which is how to complete the homework assignments. And I might be doing that for the future lectures. I might be splitting up the lectures based on concepts. Maybe one of them should be the review for the week before. Or perhaps, reviewing the answers to the homework assignments. Then the second part, I'm probably going to do the lecture part. And then the third component will be how to do the homework for the current week. Let me know if that works out better than just having one lump lecture that you have to listen through all the way to the end. And then you're going to have your lecture assignment. So all you're going to do, again, is just click on the link. It's going to take you to the Wiley Plus page, and you're going to see that you have 10 multiple choice questions. And that's based on your readings and the lecture. And again, this is just to assure that you are reading the assignments. You have one attempt to do these, so make sure that you are answering them correctly, as you only get one chance to get it correct. Then you're also going to have your homework assignment for chapter 2. And your homework assignment for chapter 2 is basically what we just covered right now in the lecture. It's only one homework problem, but the homework problem has 3 parts. It's going to give you all of these transactions, which are similar to what you did in chapter 1 for the tabular form, except you're not going to be recording them in the tabular form. You're going to be recording them as journals. So you have to determine which 2 accounts are affected and which one's a debit and which one's a credit, and you have to record it accordingly. Remember that each of you have the same problem but the different numbers. And I do that on purpose so that you do not copy each other in one form or another, okay? It's for you to be doing your own work. Now let me go over the second part right here, which may throw you off. And the reason Wiley does this is because you also, as an accountant, need to determine when a transaction needs to be recorded or not, when an event needs to be recorded or not. Remember, we have the monetary assumption that we only record stuff that pertains to money. The second transaction here that is asking you to do is on April 1st, this person hired a secretary or a receptionist at a salary of $700 per week, payable monthly. And if you notice here, this says no entry. The reason it's no entry is because when you hire someone, it doesn't necessarily mean that there's money affected by that on that particular day. Just because you hire someone doesn't mean you're going to pay them that same day. Usually you're going to pay them maybe by the following week or in 2 weeks, or sometimes you even get paid monthly. Here you hired a secretary and you determined that you're going to pay them $700 a week, payable monthly. That's it. You didn't pay them that day. Nothing happened. There's no exchange of money. That's the reason when you run across transactions like that and you know that they have no monetary value, you know that they're not supposed to be recorded, you're going to be recording that as a no entry. A no entry for the debit, a no entry for the credit, and you put 00. That is just a way of us checking that you are paying attention and that you're not just journalizing for the sake of just journalizing, because you have to make sure that you review that some of the transactions cannot be recorded because they do not involve money transferring from one place to another. And you're going to be continuing to do that for each of these transactions here. You're going to be journalizing them. Once you do that, it's going to take you to part B. And notice it says the parts of this question must be completed in order. This part will be available when a student completes the part above. If you don't do this part completely, you can't move on. It's going to take you to this. And this part, it says you have to post everything that you had in the general journal. Now you have to post it to the ledger. Remember, posting to the ledger is separating each of the transactions based on each account. So you're going to have all the transactions that are pertaining to cash in one area. All you're going to do is look for them and transfer them either as a debit or a credit, depending on how they were recorded. Like, for example, April 11 was cash as a debit, but on April 30th, there was a cash as a credit. You make sure that you journalize every single one in chronological order as a debit or credit and find the balance. And you do the same for the rest, for accounts receivable, for supplies, for accounts payable, and so on. And again, it's not going to let you go on to the next part until you finish this. And it's going to take you to part C, which is asking you to do a trial balance, which all you do is take the balances of each of the accounts and post them either as a debit or credit. Then you find the balance on each of the columns and you make sure that they balance by having the same amount. And that's it for your homework assignment. Then you're going to have a quiz. The quiz is not timed, and it's going to be based on 3 homework problems, on 3, they're called do-it or reviews, and it's going to ask you some similar questions. It's going to ask you what form should all of these activities be recorded. They're going to ask you to prepare entries in the general journal. And that's it for that homework, for that quiz problem. The other quiz problem is going to ask you to post some stuff on the T accounts. And the last problem is going to ask you for the trial balance based on these accounts here. Notice that you have, for the lecture assignment, you only have 1 attempt. So you need to make sure you do it right. It says right here, this is limited up to 1 attempt. But for the homework assignments, I think I made it for 3 attempts. You have 3 attempts to get it right. Okay? And it's not timed. And I think I did the same thing for the quiz. Let me just check that. For the quiz, I did it up to 3 times again, and it's not timed. So you have plenty of chances to get this right. This time, there's nothing for you to turn in electronically. Everything's going to be done through Wiley, so it's going to be automated. Okay? If you have any questions, let me know, and good luck to you this week.